What's up, guys? Welcome back to DCA. So what we're going to do in this video is take a look at Bitcoin and where it stands right now in relation to some of its key moving averages. The reason that we're doing this is because we have clear evidence that shows us that Bitcoin and the entire crypto market, for that matter, react in certain ways when it falls above or below various moving averages. So today we're going to look at some of those. And what I've done in order to do this is I've coded this script here, which basically shows us when we're blue. So when you see that this line is blue, this represents the price of Bitcoin. When it's blue, that means that Bitcoin is above a group of moving averages. So in this case, it's the 20-week, the 50-week, and the 100-week moving average. When it's in yellow, that means that it's fallen below that 20-week moving average. When it's in green, it's fallen below its 50-week moving average. And when it's in red, that means that it's finally fallen below its 100-week moving average. We can see that, I've heard a lot of people saying things like you can't look at the historical data for Bitcoin because it's no longer relevant because of the fact that, this and that, the market's different. And to an extent, I agree with that. However, we're seeing this market cycle play out nearly identically to the way that we've seen prior market cycles play out. So, it doesn't really seem like anything that unique is happening right here. Now, the macro circumstances, the macroeconomic and geopolitical circumstances surrounding the market are different and perhaps worse than they've been in the past. However, with regards to the price action of Bitcoin, there's really not a lot that's happening right now that's, wildly unexpected. So I'm going to show that today. And I want to show you just how important the location of Bitcoin in relation to its key moving averages, in other words, a gauge of the health of the market at any given point in time. I want to show you how important this is. All right. So we're going to do that in this video, and we're going to start by just, I'm going to explain exactly what we're looking at here. So, it's rather simple, like I said, but what we have in yellow, so down here, I just have the moving averages like you would normally expect to see them. So in yellow, we have the 20-week moving average, in green is the 50, and in red is the 100-week moving average. And what you can see is that when we fall below this 20-week, and this is what we always say on this channel, when you're below that 20-week, it's a bad sign for the market. And especially for Bitcoin, when you get below that 20-week moving average, usually you're looking at rough seas ahead. And that's exactly what we've seen here. So back in 2018, we fell below that 20. We go down to the 50, bounce off of it. We get a bounce off the 50, head back up to the 20, and then eventually break below the 50. Okay. And we just ride right along this yellow line. So right along that 20-week moving average all the way until basically when the 20-week moving average is about to cross with the 100-week moving average. Okay. So we're looking right here. And look at that, how that just identically happens in this market cycle with one small key difference. We break below the 20, things look bearish. We bounce off of the 50, just like we did here. We head back. And in this case, we did get back above that 20-week for a short amount of time. All right. And that's going to be August to November, that rally we had. But then what happens? Just like we saw in the prior cycle, we break below the 50-week moving average. And what happens? When that 20-week moving average in yellow, just like we saw here, is converging upon the 100-week moving average, just like we saw here. So the 20-week moving average is converging upon the 100-week moving average. And what has happened? We've now dropped below the 100-week moving average. Okay. So we're seeing this play out not dissimilar in any way to what we saw back in, the 2018 cycle. And even if you go back to the 2014 cycle, it's the identical thing. We fall below that 20. We bounce off the 50. We go back above the 20 for a short amount of time. Then we fall below the 50. What happens? The 20-week is converging upon the 100-week. Then we fall below the 100-week. Okay. So anyone who's sitting here telling you, I find it comical that you have these people with so much conviction saying that the market is so different now. This stuff doesn't happen anymore. You can't look at charts to understand the price movements of Bitcoin. Well, I'm showing you right now that you definitively can, because we've seen the identical price action. I mean, spot on, nearly identical, 3 market cycles in a row. You go below the 20, you bounce off the 50, you go back above or right to the 20, then you fall below the 50, then you go to the 100. As the 20 week is converging upon the 100, you drop below the 100. 1, 2, 3 times it's happened now. All right. Verbatim. It has happened identically. So I understand the argument that, in principle, it makes sense that you can't look at the chart and just say, what's going to happen. And they're right. You can't just look at the chart. You can't just rely on the chart and just say, okay, this is all this is all that we're going to do. But that's not what we're doing here. We're looking at the chart, but we're also considering other factors. We're considering the macro picture. We're considering what's going on in the economy. We're considering the economic reasons why what's happening makes sense, and what is the evidence that we have that's supporting what, the inferences we're making from the chart. So we're looking at everything. We're not just sitting here saying, because of the fact that the chart looks similar to prior cycles, and, just accepting that. So, these people that just use TA or just use fundamental analysis, there are too many tools that exist for yourself as an investor to just rely on one piece of evidence. Okay. So that's why we're trying to dig deeper here. We're trying to understand both what's happening, as it relates to Bitcoin, as it relates to the cryptocurrency market. Because as I've said many times, the cryptocurrency market, the fundamentals of this market are strong. But that doesn't matter right now. That is not what is important. What is important at this moment in time is what's happening in the economy. We are seeing that the market is playing out in a similar manner to what we've seen previously. However, that's just because we're seeing a market breakdown right now. We're seeing a market breakdown. And that means that we're playing, the whole thing's playing out like it has before. But the reason the market is breaking down is not because of crypto. It's not because there isn't institutional adoption or there isn't, a future for this market. The reason that we're seeing the market break down is because of what's happening in the economy, with the Fed, with the supply chain issues that we've talked about. These are the reasons that crypto is suffering right now. It doesn't make the asset class as a whole any less valuable. It doesn't make it, something not worth being a part of. This is what a market breakdown looks like. I mean, we're showing it right here. We're showing this is what a market breakdown looks like. But we're also going to understand, why is it breaking down? In the past, it was breaking down because of, just rampant speculation in the market and uncertainty. We didn't know what crypto was going to be yet. Now we know, or at least we have a better idea of what it is and what it can be and what its potential is. And the fact that we know there's adoption now. It's part of, it may not be a household thing yet, but it's part of the mainstream consciousness, at least. In the past, there was just Bitcoin, this thing that you saw on the news every few years that, was going up tens of thousands of %. Now it's a part of investors' consciousness, and that matters. And that kind of thing matters. But nonetheless, because we're, fundamentally bullish, because the fundamental analysis of this market is bullish, that's not going to prevent the asset class from getting hammered if the economy starts to tank, if the NASDAQ starts to tank, if we see the stock market open up massively red on Monday, for instance, and then continue red for weeks or months. That's not going to, save this asset class in the short term. But that's why we don't talk about the short term on this channel, because we don't care about the short term. The short-term investors, people that are just getting in when things are looking bullish, they're not making much money. They may make some money, but the real money is made when you're seeing Bitcoin price below this red line, below the yellow line, below the green line. And notice that's where we're at right now. We've just fallen below all 3 of those levels. We're now sitting below that 100-week moving average. All right. So that's sort of an aside to what I want to talk about today, but I think it's an important point. I think it's an important point that a lot of people are missing. You can be massively bullish in terms of your fundamentals, but it doesn't mean that you are going to be immune from a market recession. I mean, take Amazon. Amazon got hit just as hard as anything else during certain market pullbacks. But, if you believed in the fundamentals of Amazon, the pullback didn't matter, right? Because it had the fundamentals. It had all the potential in the world. So in spite of that, it still got massively hit in these market pullbacks, but nonetheless remained one of the best investments possible. So that's how you have to approach the market. And not enough people talk about this in this space because, quite frankly, there's a lot of people that, they just simply don't understand markets. They may know some things about cryptocurrency, but they don't understand that you have to remember that the technical analysis and the fundamental analysis need to be correlated with the macroeconomic picture because they are intrinsically related. You can't have you can't say that we have institutions FOMOing into this market and then at the same exact time say that everything looks bullish right now because those institutions are being influenced by the macroeconomic picture. Okay, so one of the things I want to point out here in this picture that we're seeing, we see that when we're talking about the flow of a market cycle, when Bitcoin is above its 20-week moving average indicated by a blue line, so when it's above all three of these, the 20, the 50-week, and the 100-week, when it's above those moving averages, you can see that the market rallies. It intensely rallies during that time. In fact, if that was your only trading strategy, let's suppose that that's all you did. When Bitcoin's above its 20-week moving average, you invest, and when it's below, you sell. You're talking about, and we won't even use these older examples because those are too easy. So we'll just go from, say, 2016. So when it's above this 20-week moving average, I mean, we're talking 2,000% here. And then, this was a mini rally, which was short-lived. We're talking 72%. All right. And then there was a third time here where, it would have been negligible. This would have been a wash trade. You probably would have made a few percent. So all we're saying is if you bought when Bitcoin is above its 20-week and then, you get out the second it's below its 20-week. Then in this market cycle, that would have yielded you nearly 500%. All right. And then in the second leg of this bull market, you would have been looking at 30%. So if that's all you were doing, if you just had the patience to sit back and only trade these 20-week moving averages, you see that, quite frankly, you'd probably be, spanking whatever sort of gains you made during this market cycle. Just statistically speaking, talking to the average person. Maybe some of you out there did much better than this, but I don't think a lot of people at the end of the day are going to have netted these kind of returns. So, that just shows how simply something like this could be used. You're going to have diminishing returns as we go on, simply based on the fact that the asset class, it's growing, the market cap is growing. As the market cap grows, it becomes exceedingly difficult to move the price 2,000% like we saw back here. Now, depending on how much we correct here, potentially something like that could occur. But that's all going to be dependent on, what sort of correction we're in. But now what I want to show you is, so after we fall below this 20, so yellow, when we get into the yellow, you see that we normally go down below the 50. Now I want to show you a very similar thing that occurred in both of these market cycles. When we get below the 20 and down to the 50, you'll notice that once we're below that 50, we tend to not, between the 50 and the 100, they tend to just kind of go sideways. So we were down 26% there. And if you look at this market cycle, we were down about 20%. So, and even back here, I'm sure it's more severe back here, but all the moves were, exaggerated back at this time. But even then in this massively exaggerated cycle, down 33%. But given the fact that, your market is looking ugly during these times, it's not I guess the worst thing that can happen. But what happens is when you get below this 100-week moving average, there's usually a pretty big move to the downside. Now, I don't know if that's going to happen again, but we saw a 40% move to the downside and actually a bit more than that to the bottom. So around 44% down to the bottom. So that's where we're sitting now. And, I can't definitively say whether that's going to happen again. And in fact, if we just go back and look at this cycle back here, once we got below that 100, to its bottom, we were down 51%. So I'm not going to sit here and tell you that's what's going to happen right now, but I'm just going to warn you that when you get below this 100-week moving average, the writing is on the wall, and that's when people really start to panic. And we've been showing in some recent videos, there has been a lot of panic in the market lately. There has been a lot of individuals that own up here because we showed in, a recent video how there are millions of coins sitting from 40K up to around 68K. And we showed how there's panic selling. It has started. It has officially started. I mean, it was already going on for some time, but now it's really, kicking into gear. So we've seen a big increase in the number of these, short to early stage long-term holders. So long-term holders by on-chain metrics can be defined as greater than 140 days or greater than 155 days, depending on which source you're using. So a lot of these new a lot of these new long-term holders are starting to panic sell. So when that happens, what you get are these type of events, these compulsory moves, like you saw back here in November and December of 2018, like you saw back here in December of 2014. And a lot of this is because these longer term holders also may start to sell because they see the writing on the wall as well, and they may decide to take profits here. These stages where we get below this 100-week moving average, these times can get ugly. So, I just want people to have a realization of what getting below this 100-week moving average means. Because, like we showed, this isn't that unique. This market cycle isn't that unique. Not that much is happening that's so different from these prior market cycles. All right. You have macroeconomic uncertainty influencing the market at the moment. You have Bitcoin sitting in a precarious position. All right. Now, quite frankly, this could come out and, we could go on the rally of our lifetimes right now. I don't think that's going to happen. I'm almost certain it's not. But guess what? If I'm wrong, I'm wrong. But, I think that people need to appreciate what their downside risk is. And I'm telling you this because of the fact, if you're in and you're holding, you have to decide what to do from here. I can't tell you whether you should sell or not. I can't tell you what are the right decisions for you as an investor to make because you have to know your own situation. I don't know your situation. And I can't answer anyone's, questions as to what they should do because it depends on so many different factors. But if you're the type of investor, and this is not financial advice, this is simply how I approach these markets. These times when Bitcoin is down in the red, when we're below this 100-week moving average, historically, you need to understand that when I say historically, nothing because it's happened before has to happen again. However, these times when we're down in this area, savvy investors have capitalized on these segments of the market time and time and time and time again. So on my channel, ever since right here in the beginning of December, I've been telling people you need to be careful. And you don't believe me, you can go back and watch. I have so many videos entitled The Risk of Holding Altcoins. Bitcoin falls below critical level. And my entire channel, the entire premise of my channel has been based on the fact that when you're below these levels, you need to be careful. And I've said all along, when we're below the 20, we go to the 50. When we're below the 50, we go to the 100. When we get to the 100, that's when things usually get ugly. But when things get ugly are when people create wealth for themselves. People with patience, people with conviction, and people with a little bit of, money to throw into the market on a dollar cost average basis. I'm not going to sit here and lie to you and tell you that, if you have $100 and that's all you have and you put it into Bitcoin, you're going to become rich, because you're probably not. You're just probably not. That's the bottom line. But if you're someone who, whatever your situation is, whatever your situation may be, investing over time when strong assets, and what I mean by strong assets are assets with strong fundamentals. I'm not talking about meme coins. I'm not talking, you could become rich off meme coins too, though. I'm talking about assets that, are likely to be around in, 2020X, whenever that next bull market comes around. Individuals that have money to put into those markets on a dollar cost average basis, when we are in times like these, have been rewarded time and time again. It doesn't matter if you're talking about the stock market. It doesn't matter if you're talking about crypto. It doesn't even matter if you're talking about altcoins. A lot of the crap altcoins that never come back, that never recover, if you just invested in them when they were down 95% in the last market cycle, for instance, and we're talking altcoins with no use cases here that, basically just exist for people to make money off of you. Even those coins made people a decent amount from bottom to top. But it's very difficult to know where the bottom is. It's difficult to know where the bottom is. And that's why I've been suggesting dollar cost averaging all the way down. I've been dollar cost average. Don't just throw your money away. Don't FOMO in because some idiot on Twitter or YouTube tells you, 46K is the bottom, 45K is the bottom, 38K is the bottom, 34K is the bottom. Don't listen to people, selling you snake oil, because at the end of the day, there's a lot of people out there that are, quite frankly, they're in it for them, and that's it. All right. They're making content because you're making them rich, and that's it. And I'm telling you guys, to me, this looks bad. This looks ugly. And I've been wrong before, and I'll be wrong again, but this looks ugly. So that's it for this one, guys. Until next time, as usual, see you.